Meet Kevin Warsh, President Trump's pick to succeed Jerome Powell at the helm of the Federal Reserve. But this isn't simply a change of faces. Warsh is calling for something far more ambitious, a fundamental regime change at the world's most powerful central bank. His agenda centers on restoring the Fed's credibility, sharpening its focus on inflation control, and rebuilding the institutional accountability that he believes has eroded over time. At the heart of his vision are four core priorities, each one designed to redefine how the Fed approaches monetary policy for a new era. Warsh's four priorities form a coherent, disciplined blueprint for a reformed Fed. First, anchoring inflation expectations, sending an unambiguous signal that price stability is non-negotiable, full stop. Second, restoring policy predictability, giving markets, businesses, and households the confidence to plan ahead without second-guessing the Fed's next move. Third, strengthening data-driven credibility, replacing reactive, ad hoc decisions with a more rigorous and transparent analytical framework. And fourth, adapting to structural shifts in the U.S. economy, from the productivity surge driven by artificial intelligence to the evolving dynamics of the American labor market. Taken together, these pillars point toward a more hawkish, rules-based Fed, one that leads with conviction rather than reacts with caution. Enjoying this? Like and subscribe. Your support motivates us to keep bringing you great economics content. Okay, let's continue. What does a Warsh-led Fed mean for the United States itself? The potential benefits are real. More stable inflation over the medium term would support household purchasing power. Greater policy predictability reduces uncertainty in financial markets, helping businesses plan and invest with more confidence. AI productivity tailwinds could expand the economy's capacity, and balance sheet normalization would reduce distortions in housing and bond markets. But the risks deserve equal attention. With unemployment already at 4.3%, prolonged restrictive policy could soften the labor market further. Higher long-term borrowing costs may weigh on housing affordability. And while AI productivity gains are promising, they take time. Near-term policy must still grapple with current data. Ultimately, outcomes depend on data, policy sequencing, and the speed of structural change. U.S. monetary policy rarely stays contained within borders, and a more inflation-focused Fed that keeps rates higher for longer has direct consequences for the UK and Europe. The transmission works through three primary channels. First, dollar strength. Higher U.S. rates support a stronger dollar, raising the cost of dollar-denominated imports and adding to inflationary pressures already challenging both regions. Second, financial conditions. Tighter global conditions ripple outward. Sterling and the euro face potential currency volatility, while UK and European bond markets may experience yield pressure, complicating domestic central bank decisions. Third, trade volumes. If U.S. domestic demand moderates, export volumes from the UK and Europe to the U.S. could soften, a headwind for economies already navigating their own post-pandemic adjustments. The Bank of England faces a genuine policy dilemma: cut rates and risk sterling weakness and imported inflation, or hold and weigh on domestic growth. The ECB faces a similar bind, with euro volatility and export headwinds complicating its own easing cycle. Emerging economies are structurally more sensitive to shifts in U.S. interest rates and dollar strength, and a firmer Fed policy stance activates a well-known transmission mechanism that has historically created significant volatility across emerging market asset classes. The chain runs like this. Higher U.S. rates attract capital toward dollar assets, strengthening the dollar and triggering capital outflows from emerging markets. The result? Currency depreciation, rising borrowing costs on dollar-denominated debt, and sharp pressure across equity and bond markets. For policymakers from Nairobi to Jakarta to Buenos Aires, this isn't a theoretical risk. It's a pattern they've lived through before, and one they'll need to navigate carefully if Warsh delivers the hawkish regime shift he's promised. India deserves its own chapter, because its exposure is both significant and distinctly complex. As one of the world's largest oil importers, a stronger dollar directly inflates India's energy bill, adding pressure to both headline inflation and the current account deficit. Volatile capital flows create an additional headache for the Reserve Bank of India, which must simultaneously defend the rupee, sustain economic growth, and keep inflation anchored. And yet, India is not without its defenses. A large and resilient domestic market, an ambitious structural reform agenda, and a substantial war chest of foreign exchange reserves provide meaningful insulation. And here's the counterintuitive case. If a more credible Fed ultimately delivers a more stable global environment, India, with its strong fundamentals, could emerge as a net beneficiary. So what are the key takeaways? Kevin Warsh's confirmation would mark a meaningful shift in Fed philosophy, prioritizing strict mandate adherence, smarter inflation measurement, and balance sheet discipline over the broader, more interventionist approach of recent years. The data will drive outcomes, with headline CPI at 3.3%, unemployment at 4.3%, and structural uncertainties from tariffs, immigration, and AI. The incoming chair faces a genuinely complex picture requiring careful, data-dependent navigation. And the global ripples are real. From the UK and Euro area to India and broader emerging markets, U.S. monetary policy choices transmit quickly through dollar strength, capital flows, and financial conditions, making this a genuinely global story, not just an American one. Every node in this global network feels the vibration when the Fed shifts posture. The degree of impact depends on each economy's own fundamentals and structural buffers, but no major economy is entirely insulated from Washington's decisions. That's a wrap on today's deep dive into Kevin Warsh and what his Fed chairmanship could mean for the global economy. If you found this valuable, hit the like button. It genuinely helps more people discover this content. Subscribe so you don't miss our next breakdown, and drop a comment below. What do you think Warsh's first move as Fed chair will be? We read every response. See you in the next one.